Hi, everyone. Welcome to our session today, where we feature different asset management companies, their views, and the funds that they are managing and distributing. My name is Zain Pulumbarit, and I'm the Senior Funds Analyst for COL FundSource. So in our interview today, we will talk about the global equity landscape, especially after the very strong run in the US market since November of last year. Now, to help us make sense of what happened in the first quarter and the different prospects of global opportunities heading into the second quarter of 2024, we will be joined by Paul Du. He is the head of Wealth Solutions at Manulife Philippines, where he's the specialist that overlooks at the different products they have, especially their global funds. He was previously a portfolio manager and an equity analyst for Manulife. Let's all welcome Paul Du. Hi, Paul.
Hello, hi Zane. Hello, everyone.
So, Paul, for the benefit of our viewers today, you help compile the different views and outlooks ng Manulife Global as a global investment management company. And you help discern the different products based on your overall strategy. So is that a right explanation of the work that you do?
Yeah, that's pretty much sums up what I do. Basically, Manulife is a global company, and we've taken a look at our investment strategies and investment expertise globally, and we've tried to get those investment strategies and offer it to local investors. Aside from that, we've also leveraged our partnerships with some other asset managers, and we've introduced their strategies to local investors as well.
And of the funds that you manage, right, we have 20 that we distribute, and 16 of that are global or offshore funds. So itong mga funds na to, Paul, they're a mix of equities or stocks, bonds, and even multi-asset funds, which has a mix of both. So these 16 funds are all invested overseas.
Yeah, really the goal of offering this many funds is for clients to have diversification in their investments. We've noticed that a lot of clients have been limited in terms of their investment opportunities, and we wanted to again bring the global expertise of Manulife when it comes to investing to the local market, so that there's better ways for clients to start diversifying and I guess tailor fitting their investment solutions to their needs.
So to give context, Paul, to our discussion today, US has had such a strong run since November, primarily driven by tech and AI and your expectations of the rate cuts. So can you give us a recap of what happened in the first quarter?
Yeah, actually, you're right. Global markets have done very well in the first quarter of the year. Global equities was up by around 8%. And the good thing was that unlike last year, where a lot of the rally was focused on US technology names, we're seeing much better participation in this equity rally. We're seeing sectors like financials, energy, and healthcare also join in on the rally. Global bonds, on the other hand, was down by around 2% in the first quarter, but this was mostly dragged by investment-grade bonds. So if you looked at other fixed income asset classes like preferred securities or high-yield bonds, they actually delivered a positive return to the start of the year. Now, why are global markets performing this way? It's because investors are starting to price in a soft landing scenario. So this is basically a decline in inflation and resilience in growth. So for inflation, we look at world GDP weighted inflation, and we've seen this peak at around 10% and drop all the way down to 5.5%. And this is because we're seeing some of the supply chain pressures that were present before start to ease today. And we think the next leg down for inflation will come from the demand side. So we've actually made some studies, and on average, it takes about 2 years for the rate hikes to start to trickle its way into the economy and start to weaken the economy. So that should put us on track for the middle of this year. And in terms of growth, again, we're seeing world current activity remain positive. But what we would like to say is that the UX economy has been particularly resilient, but we are monitoring some risk to growth. So like I said earlier, the rate hikes will make its way into the economy. And we're starting to see that with higher credit card delinquency rates and lower spending on some of the durable good items, which are interest rate sensitive. And then on the other side, we're also seeing some weakness in the job market. There's less rehiring going on, and the duration of unemployment is starting to move higher. So given all of this data that's now coming out for inflation and growth, we're actually seeing the outlook for interest rates start to change and be recalibrated. So for the next 6 months, we see increased risk for rates to stay higher than expected. And in fact, expectation for the first rate cut has already moved from the second quarter to the third quarter. Beyond this, we think that rates may fall more than expected in the medium term. So when we say medium term, that's about 6 months to 2 years from now. And then after that, we expect interest rates to remain higher than the post-GFC period in the long term.
So that's a good recap of what happened, Paul. No? So to summarize, we're now seeing inflation start to slow down and nagdi-dissipate na yung supply side frictions that we've had. And we've had a strong growth based on demand, but you expect that gradually that strong demand will also start to slow down. And what you guys are looking at now is that the Fed expectations of rate cuts could probably be readjusted to a higher for longer narrative. So given that the market is recalibrating your expectations, what are your expectations coming into the second quarter of the year?
Actually, on the second quarter for the year, so obviously we had a very good start to the year, but we're very mindful that we're still in a very uncertain macro environment. There's still a lot of uncertainty in areas such as monetary policy, geopolitical risk, and the recessionary risk. We're seeing expectations of these factors, again, being recalibrated almost weekly. So we think it does make sense for us to be very nimble because it's going to be a choppy ride moving forward.
So given that expectation, Paul, so we're seeing a lot of things recalibrated regularly, sometimes even daily. How should investors look into investing in the market today? I think a lot of people are wondering, if, particularly in the US, the tech and AI, a lot of people are thinking, is it too late to join into the market? Or is it too late to invest now? Or are there other opportunities that they should look at this point?
But if you look at our asset allocation views, we're still positive on equities relative to fixed income. So for those investors that are looking for capital growth, it still looks like it's a good time to be invested in equities. But what I would say is that if you want to build, let's say, core positions in equities, I would choose those funds which are more diversified and have a flexible mandate. Obviously, our funds are all being actively managed. And you pay those management fees for the fund manager to make those calls on asset allocation, on selection. So it's best to really take advantage of our global funds that can invest in a wide range of investment outlets. For example, global equities, we have two strategies there. Global Dynamic Leaders, that's a fund that we manage internally. So the lead fund manager is actually the global chief investment officer for equities in Manulife. So this person has visibility across all of the Manulife equity portfolios, and he sees which are the top ideas in all of these portfolios. So he uses that data point to choose the best ideas for his fund. And he's also being supported by our head of multi-asset solutions, which helps him decide on which geographies or which sectors to focus on. So if you want something where the fund manager can just decide based on our internal views on where the market is heading, That's one idea that you can consider. Now, again, we have a second global equity fund, which is called the Global Thematic Opportunities Fund. And this time we're working with a third-party manager, but it's pretty much a similar approach. They have multiple thematic funds, whether it's invested in clean energy, digital, health, but they take the best ideas in those individual thematic funds and they roll it up into this broader and more diversified global equity fund.
To summarize yung views that you mentioned earlier, for most investors, being diversified is a better option right now, given the risks in growth that you're seeing. So you have global dynamic if they want more large cap and leading companies, and global thematic for more varied themes that they want. But you also mentioned when we were talking na meron kayong tactical calls. So how do you navigate yung difference between the core portfolio and yung satellite or tactical views that you have?
Yeah, I think for the core portfolios, these would be funds that you can buy and hold, and you can be a bit concentrated on them. And I'm saying you can be a bit concentrated on them because the strategies themselves are already very diversified. So again, the two funds that you mentioned, Global Dynamic Leaders and Global Thematic Opportunities, they're both global equity funds. So they can invest in many geographies, in many sectors. If you look at our satellite strategies, you'll see a more limited investment universe. So for example, our US equity fund would be mostly invested in the US. Our technology fund would be mostly invested in just technology companies. So because of the restrictions that they have, you would have more concentration in those particular geographies or sectors. So what happens there is that if there is any issues, for example, that happens on the macro side that affects those specific geographies or sectors, you would have too much exposure that could lead to some, I guess, negative impact on the performance of your portfolio.
Okay. So yun yung difference between the core strategy and yung more satellite or tactical strategies that you have. So would it be appropriate, Paul, to say na for those who are just looking for a more varied exposure, they could go with the core strategy? And then for those na mas active in terms of the way they manage their portfolios or investments, they can look at the more tactical options that you have.
Yeah, that's a good way of looking at it. And you can definitely balance the two. So you could decide how much of your portfolio you want to be in more of a buy and hold approach. Then you can consider your core funds in that bucket of your portfolio. But then you can also start to add and mix some of the tactical funds or some of the satellite funds. If you have a particularly strong view on a certain geography or sector, there's definitely no limitations to the number of funds that you can invest in. You don't have to limit yourself to just one or two funds. You can use our global funds to really create a portfolio that hits just right at the investment solution that you're looking for.
So if they build a portfolio, meron silang core that they stick with, and then for those who want more active pa, they can add the tactical or satellite funds that you have or the other funds out there to build yung specific exposure na gusto nila. So kung gusto nila na exposure to tech, healthcare, specific countries like US and India, they can do so. So that's how you would give people advice in terms of constructing their portfolio.
Yeah, basically, the way that I look at it is that you're trying to bend the risk and return side of things by creating a core plus satellite portfolio using our global funds. So obviously, you can stick with the core strategy, but if you want more returns, more potential returns by taking more concentration in a specific geography or sector, then obviously we're also offering those types of strategies to clients.
So Paul, can you give us a background dun sa tactical views that you have? Why are you looking at these certain sectors or countries or geographies as part of your tactical calls or tactical portfolio?
Yeah, so just to summarize, I guess on just looking back at what our tactical views are, we do have a positive view on US equities and India equities. So for the US, we like it because it's a relatively stronger economy compared to the rest of the world. Just to, I guess, reiterate, we do expect US growth to slow down this year. But the thing is, we look at relative opportunities, and US is more resilient compared to other markets because its economy is really being supported by a strong labor market and consumer spending. Now, also, financial markets, they tend to be a bit forward-looking. So it's very possible that investors look past the slowdown in growth and they look straight to the recovery. So if you look at our interest rate expectations, again, the short term is obviously higher than expected. But if you look at the medium term, we think interest rates could fall more than expected, which would be good for the equity markets. We're also optimistic that we're seeing higher breadth or higher participation in the corporate earnings growth this year. So this can benefit your undervalued areas of the US market. Last year, it was very concentrated in US technology names, but this year we could see more participation from small cap or dividend stocks, as well as your traditional value sectors. In fact, if you look at our asset allocation views, our team recently upgraded US small cap equities to a positive view. And that's because they think that asset class can benefit from higher market participation as well as the expected rate cuts, as long as the US is able to navigate around a steep recession.
So that's your call on US. How about your other tactical views on India, technology, and healthcare?
Yeah, I guess I'll start with India just to finish up the different countries that we have a positive view on. So actually within Asia, we have a neutral view on equities. But there is a bright spot in Asia, and we think that India is a preferred market. So GDP growth in that country has been exceeding expectations for the past 4 quarters already. And we think this is being driven by two structural growth drivers that will continue to sustain this growth. The first is digitalization, which is actually formalizing its economy. So you're getting more of that shadow economy back into the formal economy, which will be good in terms of sustaining the growth. And the second is the reinvestment policies, which is helping its manufacturing sector. So these are two very strong drivers. And what's actually another good thing about India is we're seeing increased interest from foreign investors. So starting this year, Indian bonds are being included in some of the major indices around the world. So that's getting more eyes looking at India. So that's good for their capital flows and their external accounts as well. Now, if we talk to our fund manager in India, he also has so many ideas, bottom-up ideas on Indian companies that can be great investment outlets for the fund. So he looks at this 5Ds framework. So he looks at companies which are either into digitization, deglobalization, decarbonization, demographics, and deficit reduction. If it falls within those 5 themes or it intersects in more than one of those themes, then it's definitely a candidate for inclusion in our fund.
So to summarize, Paul, yung view mo on the US and India, US more of slowdown, but the structural recovery is there. And people are now overlooking yung slowdown, you'd say na the recovery is already what people are expecting for. So they're willing to.
Yeah, I would say it's more on the relative growth of the US, where the economy is relatively more resilient, because even if it will slow down, you still have that strong labor market and consumer spending, which is keeping it, I guess, keeping it better compared to other economies in the world. Then you also have the better participation in the market, which we're seeing today.
Okay. And then sa India naman, that's where the structural and economic growth is happening now that India is becoming more globalized in terms of the financial assets and yung exposure nila to other markets around the world or yung visibility nila to other investors around the world?
Yeah, that's right. India's just an attractive growth story at this point. There's structural drivers that are allowing it to sustain the growth. And there's a lot of bottom-up ideas that you can invest in through the fund.
So any other tactical views that you prefer right now?
Well, I guess going into the sectors, technology, it's a fund that has done well last year and continues to do well in the first quarter. So I think after a nearly 50% run up last year, it's up by another 14% in the first quarter of the year. When we talk to the fund manager, he's still quite positive on the sector. There's two things driving that optimism. The first is he's seeing an inflection point in terms of earnings and revenue growth. So previously you were dealing with a high base, which is coming from the pandemic demand that was built up. So you were dealing with that high base, but that's starting to taper off and growth is starting to return. And then the second is obviously the optimism when it comes to generative AI. So that part, I guess you could say that we're moving now towards the application phase. Previously, we were in the experimentation phase. So there was a lot of R&D expenses that benefited a lot of your semiconductor companies, for example. But now as we move to the application phase, you're seeing more and more potential use cases for generative AI. So that benefits a different subsector of technology. You can see benefits, for example, in software companies or internet services. So that could help sustain the growth. It's a different subsector now which can benefit from this thematic. And then I guess just to finish it up, the last sector that we're actually quite interested in is healthcare. So again, we do have a fund that's focused on this sector. What we like about it is that it's a very defensive sector. So obviously the demand for healthcare products and services are inelastic. So if the economy goes down, people will still be buying these products and services because it's such a need for people, you know. And we've seen this in terms of its earnings. If you look at the variability in earnings of the healthcare sector, it's much lower compared to the general market. So this would be something that's interesting if we're expecting the overall growth of the economy to start slowing down because it's a very defensive sector. Plus, on top of that, there's still exciting growth potential in healthcare. We're seeing earnings estimates start to improve and valuations are actually quite reasonable for healthcare. This is because it's been a laggard last year, but we think there's potential for it to start catching up. And if we talk to the fund manager, again, there's a lot of actionable investment ideas. There are a lot of healthcare companies which are innovating, and they're there to address some very glaring medical needs. We see a lot of opportunities, especially in the biopharmaceuticals sector.
So there's a lot of opportunities pa rin, Paul, in the market today. Despite growth potentially slowing down, there are still key themes and sectors that investors can look into if they want to participate in the market today. So I guess, Paul, let's look naman on the opposite side. We talked about why you're optimistic on these opportunities and sectors, but what are the potential risks that you're seeing in the market today that will make you reevaluate your views?
Yeah, like I said, the biggest risks that are being faced by the market today are really on the uncertainty surrounding, let's say, monetary policy, geopolitical risk, and recessionary risk. These are macro drivers which can definitely change the allocations of investors depending on how the expectations start to move. So, for example, geopolitical risk, we mentioned that inflation, we're seeing we're seeing the supply chain pressure start to ease. But obviously, if we get renewed geopolitical tensions in other countries, that could start to come back and it could affect the inflation data that we see. Obviously, that has a spillover effect on, let's say, monetary policy and how we also view the growth slowdown moving forward.
So very perceptive views on the market today, Paul. Once again, thank you for your time and the insights that you shared with us today. Now, as we've learned from Paul, even if global markets have already had a very strong performance, there are still pockets of opportunities for investors to tap throughout the second quarter and beyond. But investors must manage their expectations as markets do not go up in a straight line. Some slowdown can be expected as interest rates remain high and growth starts to soften. Nonetheless, the general outlook remains intact. Investors can manage their global investments by having a core investment strategy that is diversified across countries and sectors. Active investors can also supplement it by having tactical exposures in certain themes and trends like the examples that we've discussed today. To check out Manulife's funds and other global funds, log into your COL account and click on the Mutual Fund tab to explore the different funds that you can invest using your COL account.